380,627 vehicles were registered in the UK in March, the biggest monthly figure since 2019. Brent crude is trading above $113 a barrel. The Strait of Hormuz remains effectively closed. Petrol prices are near record highs. Those two facts should not coexist. High-cost, war-anxiety environments kill big-ticket discretionary spending. That is the conventional read. Bloomberg reported Tuesday that the UK car sales figures suggest the conflict in the Middle East hasn't yet stopped consumers from making pricey purchases, framing it as a resilient story. The SMMT data confirmed plug-in hybrids surged 47%. But the headline number buries the more telling detail. The top-selling model in the UK last month was not a Ford, not a Volkswagen, not a Toyota. It was an SUV from China's Chery Automobile. That is not a footnote. That is the story. UK car sales rise to highest since 2019 in resilient showing, as Bloomberg headlined it. The resilience belongs to a different beneficiary than the one markets assumed. Here is what happened beneath the surface. Trump's 10% global tariff, imposed under Section 1226 in February 2026, diverted Chinese manufactured goods from US-bound supply chains towards alternative markets. The UK, running a looser tariff regime relative to the US, became one of the primary destinations for redirected Chinese export volume, including vehicles. Chery had been building UK market share quietly through 2025. But with US market access narrowing for Chinese automakers, the incentive to price aggressively into Europe and the UK intensified sharply this year. The result? A Chinese brand topped the UK sales chart at the precise moment that Bloomberg was writing about British consumer resilience. The dynamic pricing warning that Bank of England Deputy Governor Claire Lombardelli issued on Tuesday adds another layer. She flagged that frequent real-time price adjustments by UK firms could anchor higher inflation expectations in household psychology, even when overall CPI hasn't moved yet. Chery's UK pricing does not move in real time with sterling fluctuations the way domestic brands do. That is a structural cost advantage that British and European manufacturers cannot replicate quickly. US shale drillers seen lifting output on Hormuz-driven price rally, as Bloomberg separately reported, which means the oil price spike that was supposed to suppress consumer spending is instead generating capital that flows back through energy exporters, into global demand, and partly into vehicle purchases through fleet and commercial channels. The FTSE 100's mild plus 0.25% close on Tuesday masked this divergence entirely. Energy stocks lifted the headline index. Consumer discretionary told a quieter story.
The Chery win in UK sales is not purely organic demand. It is partly structural trade diversion, and that creates a conditional durability question. If the US and China reach any partial accommodation on tariffs, or if Trump's Iran deadline produces a negotiated Hormuz reopening that eases overall trade pressure, the incentive for Chinese automakers to aggressively price into the UK diminishes. That would be the condition that slows the redirect. The weight of evidence here points toward continued Chinese brand penetration in UK car sales through at least mid-2026. The tariff architecture has not changed. Hormuz status remains unresolved as of Tuesday's close, and Chinese manufacturers have now established UK brand presence at scale. Brand presence is sticky in ways that price incentives are not. The off-gem price cap fell 6.7% from April 1st, which partially restores household purchase capacity, another tailwind for the sales trend. The break condition is a rapid US-China tariff rollback combined with a Hormuz reopening before June. Either alone is insufficient. Both together would remove the structural incentive. One verification benchmark for tomorrow: watch Chery's UK monthly registration data when SMMT releases April figures in early May. If Chery holds the top position for a second consecutive month, the redirect is structural, not a March anomaly. If traditional European brands reclaim the top, it was a one-month pricing event. The FTSE 100's energy weighting made Tuesday's session look stable. The consumer data underneath it is being rewritten by a player most UK analysts have not yet priced into their models.